NextEra Energy is holding the keys to the AI revolution, sitting on a 12-gigawatt data center pipeline that most companies could only dream of. But hiding just beneath the surface of this incredible growth story is a terrifying financial tension, one that the broader market seems to be completely missing. You see, the very capital required to fuel this massive AI infrastructure play is putting an immense, almost unimaginable strain on the company's balance sheet. As of the second quarter of 2026, NextEra is dragging around a staggering $98.79 billion debt load. Just to put that into perspective, that debt burden is larger than the entire market capitalization of most S&P 500 companies. So the billion-dollar question we have to answer in this explainer is this. Is NextEra Energy the ultimate wide-moat compounder for the clean energy transition? Or is it a massive debt trap waiting to spring if interest rates stay high or regulatory approvals falter? We're going to break down the exact numbers, look at their massive $67 billion Dominion Energy merger, and map out exactly where the stock could realistically be 5 years from now. Here is our roadmap for today. 1. The AI power engine. 2. The 98B anchor. 3. Earnings and evidence. 4. The quality scorecard. And 5. Valuation scenarios. Section 1. The AI power engine. To really grasp the risk here, we first have to understand the fundamental mechanics of how this company actually makes money. NextEra Energy isn't just your standard utility. It's this highly unique hybrid beast operating the premier clean energy infrastructure platform in North America. The business is structurally divided into two main segments, which creates a really fascinating economic moat. First, you've got Florida Power and Light, or FPL. This is a rate-regulated legal monopoly in the state of Florida. It is governed by cost of service regulation. That means every single dollar they invest, whether that's in grid hardening, new transmission lines, or solar expansion, earns a highly predictable, authorized return on equity of 10.6% to 11.8%. They literally have a guaranteed, legally protected profit margin on approved infrastructure investments. Then you have the second engine, NextEra Energy Resources, or NERR. This is their highly competitive, non-regulated arm, and it just so happens to be the world's largest producer of wind and solar power. But the entire landscape of this company shifted in May 2026 when NextEra announced a $67 billion all-stock merger with Dominion Energy. When this closes, which they expect in the second half of 2027, the pro forma business mix changes completely. Adding Dominion's massive, heavily regulated utility operations pushes the combined company's regulated business mix to over 80% of consolidated EBITDA. By expanding that monopoly footprint, they massively de-risk the entire platform. They're basically building a highly visible cash flow engine that can confidently fund the hypergrowth of their competitive clean energy side. The strength of this economic moat gets even more obvious when you look at the underlying drivers. On the regulated side, FPL serves over 5.8 million captive accounts. Now, usually monopolies face heavy scrutiny, but because NextEra has such immense scale and a highly modernized generation fleet, they actually manage to keep average residential bills about 40% below the national average. That specific dynamic keeps regulators incredibly happy and protects those authorized returns. But the true explosive growth catalyst, the reason institutional money is pouring in right now, is the artificial intelligence tailwind. Hyperscalers like Microsoft, Google, and Amazon are building massive AI data centers, and they are facing a severe power bottleneck. NextEra currently has 21 gigawatts of commercial large load interest. Out of that, a staggering 12 gigawatts of data center demand is already in advanced talks. To put 12 gigawatts into perspective, a standard nuclear reactor produces about 1 gigawatt. This is a monumental amount of electricity, and NextEra wields the ultimate competitive weapon to actually capture this demand, and that's supply chain dominance. While smaller renewable developers are choking on component bottlenecks and multi-year delays, NextEra is leveraging its massive balance sheet to secure solar panels and utility-scale batteries fully through 2029 and domestic wind components through 2027. If you're a massive tech company needing immediate power to win the AI arms race, NextEra is one of the only players on the continent who can actually guarantee speed to market. This hybrid structure is exactly why NextEra commands a massive premium in the broader market, currently trading at a trailing PE multiple of about 22.7 times. When you compare them to peers, the difference in strategy is pretty stark. Look at traditional giants like Duke Energy or Southern Company. They are incredibly stable, defensive investments, but they completely lack that hyper-growth competitive renewables engine. Southern Company is targeting a 7.23% EPS compound annual growth rate. NextEra, on the other hand, is targeting 9% or higher, specifically because of their post-merger integration and that AI upside. Then you have a company like Constellation Energy. Constellation offers explosive growth, targeting over 20%, heavily tied to nuclear power for AI. However, Constellation carries significantly higher merchant power price risk. They sell a large portion of their power into the open, wholesale market. If energy prices crash, their margins compress violently. NextEra mitigates this by having 80% of its business locked into regulated monopolies, insulating investors from open market price swings. It essentially gives investors the best of both worlds, utility-grade safety combined with tech-adjacent growth. Section 2. The 98B Anchor. Which brings us sharply to the other side of the coin, the bear case. The existential threat to that premium valuation. Building out the infrastructure for the AI revolution requires staggering amounts of upfront capital. Before you can collect a single dime of recurring revenue, you have to spend billions laying transmission lines, fortifying grids against hurricanes, and procuring utility-scale solar fields. Because of this constant need for infrastructure deployment, NextEra is chronically burning cash. Over the trailing 12 months ended March 2026, their free cash flow sat at a negative $15.4 billion. Let me repeat that, negative $15.4 billion. This means the underlying business operations simply do not generate enough cash to fund their own growth. As a result, the company is completely reliant on continuous, uninterrupted access to the debt and equity capital markets to fund its pipeline and pay its dividend. And that intense reliance on the capital markets has built the $98 billion anchor we talked about at the beginning of this explainer. The market's primary fear is crystallized right here in their leverage ratios. NextEra's debt-to-EBITDA ratio currently sits highly elevated, fluctuating between 6.1 and 6.4 times. For context, the healthy sector average for utilities typically rests comfortably between 4.5 and 5.5 times. In a higher-for-longer interest rate environment, carrying this much debt is a massive execution risk. Management themselves estimate that just a 50 basis point increase in interest rates would negatively impact adjusted earnings per share by up to 3 cents annually by 2028, as borrowing costs eat directly into the bottom line. Now compound this existing leverage with the incredible financing complexity of absorbing a $67 billion acquisition like Dominion Energy. If interest rates remain restrictive, or if the integration faces costly delays, the cost to service this mountain of debt will absolutely skyrocket. This is the exact tension that is keeping institutional investors awake at night.
Section 3. Earnings and Evidence.
Let's look at how these massive operational and financial tensions are actually playing out in real time. We have the hard proof points from their latest fiscal quarter, Q2 2026, which was officially reported on July 24, 2026. And the results were noticeably mixed, which perfectly illustrates the complex, lumpy nature of a business at this scale. On the bottom line, it was a very strong quarter. Adjusted EPS came in at $1.15, which was a 5.5% beat over the consensus analyst estimate of $1.09. Management was confident enough on the earnings call to actually reaffirm their full-year guidance, noting they'd likely push toward the high end of their targeted range. However, the top line told a completely different story. Total operating revenues came in at $7.53 billion, missing Wall Street estimates by over 8%, representing a shortfall of roughly $660 million. Now, it is critical to understand the mechanics behind this miss. Management clarified that this was primarily driven by two factors: fluctuations in fuel pass-through costs and project construction timing. In the utility space, fuel costs are often passed directly to the consumer, so if natural gas prices drop, revenues fall, but profits remain totally insulated. The timing delays on mega projects, however, show that while the profits are ultimately secure, quarter-to-quarter revenue can be highly volatile. Meanwhile, their aggressive capital deployment is fully on track, with the regulated Florida arm pushing out $2.8 billion in capital expenditures just in this quarter alone, continuing to aggressively grow their protected rate base. But if you want to know if the long-term compounding engine is still accelerating despite that top-line revenue timing miss, just look at this number, 35.1 gigawatts. In Q2 2026 alone, the competitive arm originated 3.6 gigawatts of new wind, solar, and battery storage projects. That rapid origination brings their total competitive development backlog to an all-time record of 35.1 gigawatts. The enterprise-level demand for green energy is absolutely there, it's translating into contracted projects, and it is accelerating fast. And hey, by the way, if you like deep, evidence-based stock breakdowns like this, make sure you're subscribed. Section 4. The Quality Scorecard. Stepping back from all the quarterly noise, we run the fundamental business quality through a rigorous evaluation to see if the underlying enterprise actually justifies the balance sheet risk. Overall, NextEra earns an 8.3 out of 10. The business viability and market position are practically flawless. You're looking at a legal monopoly holding the dominant global position in clean energy deployment. Post-merger, they will oversee the largest regulated rate base in the United States, giving them unparalleled pricing power and economic durability. But the story gets highly complicated under the hood. Our financial health score drops sharply to a 6, entirely driven by that highly leveraged capital structure and the reliance on continuous access to outside capital. Couple that with the management score of 8. While executive compensation is heavily tied to total shareholder return, we have seen some notable, concentrated open market insider selling recently. CEO John Ketchum, along with Executive Vice Presidents Ronald Reagan and Charles Sieving, have sold millions of dollars in stock over the past 6 months, with absolutely zero insider purchases reported to offset it. Now, while this can often be standard personal portfolio diversification, given the massive debt load and the complexity of the pending Dominion merger, it is a dynamic you definitely must monitor closely. All of the research behind this explainer was created using Flash by StockSentinel.ai. You can generate deep research reports like this one for any public company in the world, completely free at FlashStockSentinel.ai. The core company research is free. If you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week, it surfaces the highest conviction ideas across 3 investor styles: long-term compounders, quality businesses built to compound for years; hidden gems, under-the-radar names with asymmetric upside; dividend hunters, durable income with the fundamentals to back it up. Portfolio Watch monitors your portfolio and flags important changes. Insider IQ tracks meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of this explainer. Scan it to download the Flash app and try it yourself, or access Flash on the web at flashstocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases.
Section 5. Valuation Scenarios.
Before we translate these fundamentals into our mathematical models, I need to be perfectly clear. This is a hypothetical framework for thinking about possible outcomes. It is not a prediction, and it is not financial advice. This stock could go much higher or much lower than any of these scenarios. We are modeling 3 fundamentally driven outcomes targeted for 2031. This is built off of a base earnings per share of $3.71, assuming a current share price of $89.19. Let's break down the logic of the base case, which holds a 60% probability weighting. Operationally, this scenario demands that NextEra successfully integrates the Dominion Energy assets by late 2027 without any major regulatory concessions. On the ground, this means Florida Power & Light converts that massive 8-gigawatt large load pipeline into contracted revenue, capturing aggressive data center demand across both Florida and Virginia's key technology corridors. If they execute this efficiently, it drives a 9.2% adjusted EPS compound annual growth rate. Assuming a slightly contracted 21 times forward PE multiple, which accurately reflects a normalized, slightly higher interest rate environment, we land at a 2031 EPS of $6.29. That implies a share price of $132.11, delivering a solid 10.51% annualized return. In the high case, weighted at 20%, domestic electrification accelerates wildly beyond base expectations. The critical operational driver here is the rapid monetization of small modular reactor, or SMR, nuclear co-location. This essentially means they successfully bypassed backlogged grid queues by physically locating hyperscaler data centers directly adjacent to their nuclear generation sites. The competitive arm executes on over 30 gigawatts of new generation smoothly, EPS growth accelerates to a 10.5% CAGR. The market enthusiastically rewards this flawless execution with a premium 23 times multiple, pushing the implied price to $155.34, or nearly a 14% annualized return. But the real story is what happens if the balance sheet realities break the thesis in the low case, which is also weighted at 20%. To end up in that low case, which models a meager 3.5% annualized return and a brutal multiple contraction down to 17 times, specific structural elements of the business have to fail. Here are the concrete early warning signs you need to watch to see if this risk is actually materializing. First, closely monitor the merger arbitrage spread between NextEra and Dominion. If state regulators in Virginia or the Carolinas push back against the merger to protect their local ratepayers or impose highly restrictive conditions, NextEra could face integration delays, massive termination fees, and lose direct access to those critical data center growth corridors. Second, watch for regulatory pushback in Florida. FPL's current earned regulatory return on equity of 11.7% is a massive, incredibly lucrative earnings driver. If political pressure forces state utility commissions to adjust those allowed returns downward, specifically falling below 9.8%, utility margins will compress rapidly and the core cash engine stalls. Finally, the debt. If that debt-to-EBITDA ratio creeps above 6.5 times, they run a severe risk of credit rating downgrades. In an environment where 10-year Treasury yields stay persistently high, a credit downgrade would cause their borrowing costs to skyrocket. This would effectively squeeze the profit margins right out of their massive clean energy pipeline, totally destroying the economic viability of future projects. So we come right back to the central tension. Will NextEra's AI engine outrun its balance sheet? Here are the top 3 takeaways you need to remember. 1. NextEra Energy possesses a uniquely powerful dual moat. The absolute cash flow visibility of a regulated utility perfectly funds and complements the hypergrowth of a global clean energy developer. 2. The upcoming Dominion catalyst is monumental. It only solidifies their direct access to the most dense, power-hungry data center corridors on the planet. But 3. You simply cannot ignore the $98 billion anchor. This company is highly sensitive to the cost of capital, and its premium valuation leaves very little room for integration errors, regulatory missteps, or prolonged high interest rates. So the one key thing to watch next is how those Dominion regulatory approvals shake out over the next few quarters. If you want the full research, including the deeper framework behind this explainer, you can get it free at flash.stocksentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.